So, hello and good evening, everyone. I am Mansi Ghanekar, working in the Investor Education Department of NISM. NISM is the capacity building initiative of SEBI. We at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. At NISM, we work in five broad areas: long and short term academic programs, certifications for market intermediaries, e learning programs, training programs for working professionals and academia, and various investor education initiatives. We introduce a series on Beyond Returns, a practical guide to investing, financial planning, and life, comprising four episodes scheduled on every Wednesday of May 2026. Today is the second episode of the series on the topic The Simple Idea That Makes Investing Easier: Diversification by CA Harsh Rungta. Mr. Harsh Rungta is a chartered accountant and a seasoned personal finance expert with extensive experience at ICICI, where he played a key role in building its retail lending business. Now, I would request Harsh sir to begin with the session.
Thank you, Mansi, and good evening, everybody. I see that we have quite a few participants, so let's get started. Uh, uh, I think you're able to see my screen.
No, sir, you need to share your screen.
No, I need to share. Oh, uh, this is share. You're able to see it now.
Yes, sir.
So, good evening once again, and let's get started. Uh, I think some of you would have attended the first episode before we start the mandatory SEBI disclosure, which you can read. Of more importance is the fact that anything investment recommendation at all, please consult with a specific investment advice. So, a quick revision of what we did last time, why investing feels so difficult, even when you do it right. So, those of you who attended last time can remember. Those who didn't, I think we are sharing the YouTube link where you can watch that particular episode of 50% return. And obviously, that comes with very, very high risks. On the other hand, if principles terms, uh, products, investments like and fixed deposits do not give high returns. They will invariably give. Issue with safe products is that over time they cannot protect the purchasing power of the will remember. We also studied,
Hello.
we looked
Hello.
at
Sir,
the
sorry to interrupt, but your voice is breaking a
particular.
lot. Hello. So your voice is breaking a lot. That's the reason why I interrupt you. Sorry.
Oh,
Yes, yes,
okay.
please check.
Uh,
Yes. And also your video is freezed.
okay. So what is it better we have connected? connection
Yes, yes.
problem.
It might be, sir.
Uh, we are at the mercy of the connection. Uh, it's working now, right?
No, sir, sorry, but no.
Still not working.
No. Your video is freeze. Can you just turn on and off your camera?
Well, my connection is okay. Stop video. Is it now? Can you hear me better?
Yes, we can hear you.
Are you able? Okay, so let me do this with little time, at least with the camera turned off.
Mm-hmm. Sure.
Right? Let me try with the camera turned off a little while then. So let me proceed. I think last time we discussed those three parameters: risk, return, and liquidity, which can be used to evaluate even the most sophisticated investments. We also saw examples of actually led to very poor returns and in fact even negative returns. Also, we saw the example of a particular investment that after 10 years gave a return of 13% plus, but during the period, at the end of 5.5 years, it showed loss. So good returns comes with uncomfortable journeys. I think that is what we had seen. And these are the various reasons which we collated, which showed that sometimes even the best investments, which eventually turn out to be good or very good investments, during the journey they may feel like a mistake. Let's now jump to what we will be learning today. First, we saw that systematic investment in stock markets gives good returns. You do systematically hold it for 6 years. You do systematically exit systematically over the last 2 years. We saw that if you did that, the returns were pretty good. Okay. So if those returns are good, why even look at any other investment like gold or into look at that? And if all these three kinds of investments, the Indian stock market, international stock market, put all your money in that one single investment, okay? We will look at why that kind of a strategy doesn't work and why combining them rather than doing one or the other, why combining them works much, much better. First, let's start with systematic investment. If the stock market is giving good return, why should we look at any other investment? And before we do that, let's examine what has been the return. Gold का क्या return रहा है? US stock markets what has been the return? Let's examine that. I'm going to try and put my video on. So before we start, I want the participants to take a poll. How many of you think that has gold made a loss over a 6 year period? Answer is yes or no. So let's find out how many of you think that gold has made a loss over a 6-year period? I mean, this is a pretty simple question, so I'm just going to give you 5 seconds more. Five, four, three, two, one. Let's close the poll. Let's see the answers. So only 25% people feel that gold has made losses over 6 years. Three-fourths of you, fully three-fourths of you feel that gold has never made a loss uh, over 6 years. And this just goes to show that public opinion is not always right. We will see later, I will show you data that will prove that over a 6-year period, gold has indeed made a capital loss. We will come to that a little later. So, अगर ये if this would have been a question in KBC and a participant had asked for public poll, then following that the participant would have lost. And that is the issue with gold. Everybody thinks that gold gives returns equal to inflation. We see that we've done a very detailed analysis. We've done analysis which is called a rolling return analysis, and let me take a little time to explain this here. What we did is we started with this 13th August 2001. There is a reason why we started on that date and we've done data till 31st December 2025. And we looked at all possible 1-year periods. The first 1-year period that we 2001. And if you held on to that investment of 1 lakh on 13th of August 2002, that investment was worth 1,36,558. This is data. The gold prices have been picked up from IBJA, the Indian Bullion Jewelers Association. That gave a return of 36.56%. Then we went on to the next 1-year period. 1 lakh invested on 14th August, just one day later, 14th August 2001, and redeemed one day later, 14th August 2002. There 1 lakh became 1,35,859, or the return had dropped to 35.86%. We change another day, 16th August 2001 to 16 bit, and so we just kept shifting it one day at a time till we reached the 5,932nd 1 year, which was you invested 1 lakh on 31st December 2024 and redeemed that 1 lakh on 31st December 2025. That was a superlative return of 74%. But please don't go just by these 4 published results. Over the total 5,932 observations, there was a period during which a loss of minus 19.7% was there over 1 year. The average of these 5,932 returns was 15.73%. The maximum from these 5,932 observations was 80.79. And if you put this across in a line, so these are number of observations 5,932. The worst observation was 20%, which is 7th June 2016 to 7th June 2017. 1 lakh had become 80,000. I mean, some of you might recall this, right? This is, you made the investment before demonetization and you redeemed it after demonetization. The average return of all the 5,932 observations was 15.74%. The maximum was 81%, which is pretty recent, which is 26th December 2025, 24 to 26th December 2025. So this was basically, you can see that the spread is pretty high, minus 20% plus 81%, average 0.74%. Then we did all possible 2-year returns. Again, very similar principles. This is a very powerful technique to look at returns. You are not looking at one single instance of एक साल का एक रिटर्न नहीं देखते हैं हम लोग जितने एक साल के रिटर्न्स थे सारे देखे 5,932 अब 2 साल के रिटर्न्स देख रहे हैं आपने शुरू किया 13 अगस्त 2001 को 2 साल बाद एग्जैक्टली 2 साल बाद 13 अगस्त 2003 को बेच दिया तो 1 लाख हो गया 1,43,386 दैट इज अ रिटर्न ऑफ 19.74%. Second 2-year period is 14th August 2001 to 14th August 2003. 1 लाख हो गया 1,43,928. थर्ड 2-year period, ये बीच में छुट्टी होगी इतने दिन. Third 2-year period is 20th August 2001 and 20th August 2003. ऐसे करके 5,566 2-year period आपका 1 लाख बन गया 2,10,160. You invested on 31st December 2023 and redeemed on 31st December 2025. The return was 45% nearly. And you can see that the minimum, even in 2 years, there is a loss. The minimum return is minus 11. The average is 14%. The maximum is 48.80%. अगर एक्सक्यूज अगर इसको हम इस पे प्लॉट करें ये तो पहले साल का था ही जो हमने डाला अब इसके ऊपर ये सेकेंड ईयर के रिटर्न्स डाले हैं द मिनिमम वाज minus 11%. That was 28th August 2013 to 28th August 2015. The best was 49%, which is 17th August 23 to 17th August 25. Average was 14%. So you can see that the 2-year period is much less spread out than the 1-year period. ये minus 20 plus 81, ये minus 11 plus 49. The minimum is higher than the 1-year minimum. The maximum is lower than the 1-year maximum. And the average is also lower. So that way, we did the same analysis for 3 years rolling, 4 years rolling, 5 years rolling, and up to 10 years rolling. You can see this that when you put all these, this is 1 year, this is 2 years, this is 3 years, this is fourth year, fifth year, sixth year. You remember the poll November 2012 to 6th November 2018 when a 1 lakh investment in gold became 95,000. Even there, after that, of course, there has been no 7-year period during which gold made a loss. Those of you, if we look at the Nifty, uh, if we will go and look at the Nifty, Okay. Nifty, it took 7 years before, there was no loss, right? This only takes 6 years. And you can keep seeing this as the period of holding keeps increasing, the the bar becomes smaller and smaller. The gap between minimum and maximum keeps reducing. And the 10th year, there are two products. One is one time investment in gold and redemption after 10 years. The second one is what we call the systematic investment and systematic exit. One minute. Okay. So you can see that when you do systematic entry and systematic exit over 10 years, the minimum again goes up from 4 to 6, the maximum drops, the average also drops. So as you increase the period of holding, as you increase the period of holding, you can see that it sort of tapers in. The return goes towards the average. So that really is the beauty of holding it for long, and the beauty of doing a systematic investment holding and a systematic exit, which is basically this. And the data exists which says that when gold goes up over 10 years, the gold goes up over 10 years when the stock market is down, and reverse is also true. Gold goes down over 10 years when the stock market goes up. And the data is here. These are the return, 10-year return. The golden line, of course, is the 10-year return of gold, and the green line is the 10-year return of Nifty. And you can see the circled areas where it varies so much. You can just see from here how it varies, right? Look at this. Nifty has done so well, gold is here. Gold has done so well, this will be somewhere in 2000 11 or so. 10-year period ended 2011. Gold has done so well. Nifty has done little better, but I mean, it's done better than average, but still here. And you can see here, this is the Nifty average line, 12%. Okay. You can see here for a very extended period, Nifty did much better, gold did much worse. Till in 25, it reversed where gold has taken off. Please remember, this is till 31st December 2025. So gold has done much better on the 10-year period ended 25 than what Nifty has done. Basically, they are inversely related. Okay. So gold gives good annual average returns of 12% over 10 years. It is inversely related to the stock market. And it is therefore a good hedge because it is inversely related. जब stock market अच्छा नहीं देता है तो gold देता है. That is why it makes a good mix with the stock market to stabilize your overall returns from any portfolio. And that is the reason that most planners recommend between 8 to 10% allocation to gold. Before we take this poll, I just want, if you can tell in the chat whether this whole rolling returns thing I was able to explain well. Just before the poll, Sahil, just a minute. In the chat, if people can let us know whether they have understood the rolling return, this whole basis of rolling returns that I explained. If we can have people talking about it in the chat, please just put in a yes or a no, or it was complicated, etc. Sahil, if you can read the chats and tell me what people are saying.
Sure, sir. Sure, sir. They can type in Q&A. Yes, I can see Sanjay, Sunil, Gautam are saying yes regarding it, and yes, I can see a few. Yes, also Rajesh and many others are saying yes. Yes, sir, understood very well, sir, and something like that, sir.
Excellent. Excellent. Because last time we had some feedback that it was too technical, and therefore I wanted to go little slow. So
Okay.
now let's
Okay,
take
sir.
the poll. We saw gold. We saw that gold has given negative returns over 6 years. Okay. We also saw that gold on an average gives 12% return. That is 2x of inflation. Okay. Inflation, if you take at 6%. So, I mean, this whole theory that gold gives returns equal to inflation is just that. It is theory, it is not backed by data. Data tells us that gold gives returns almost as good as equity. It's less volatile, it oscillates much less. Returns are slightly lower than equity, but it is much, much less volatile than equity. Now, let us move to the second poll. In people's opinion, does the US stock market, and that represented by Standard and Poor 500, which is like our Nifty 50, is the index of the top 50 companies. S&P 500 is the index of the top 500 companies in the US. So does S&P 500 beat Nifty 50 over 10 years? Answer yes or no. Okay. Yes, it beats the Nifty 50. No, it does not beat the Nifty 50. Looking forward to your answers. It's a straightforward question over 10 years. We will close in 5 seconds. 5, 4, 3, 2, 1. Can we have the results? Okay. This time, public opinion is right. Okay. S&P 500 does beat Nifty 50 just about barely. It is not, I mean, there's not much to choose from. And please remember, we are comparing returns in of S&P 500 in Indian rupees. So it takes the Indian rupee conversion into account. That with Nifty 50. You could also do the reverse. You can convert Nifty 50 into dollars and compare it with S&P 500 returns. We have done the reverse. We have converted S&P 500 into Indian rupees and uh, checked it against the Nifty 50 returns. So we will show you the data that proves that the participants, the two-thirds of the participants were right. We now, since people have understood how the 1 year rolling returns were calculated, I'm going to go through this quickly. We have done this 1 year rolling return for S&P 500 as well, and these are the results. There are 5,614 1 year returns for the S&P 500. The worst result was minus 33%. The best result was plus 69%. Average was 13.69. And as you can see, if we spread it like this, the bar is pretty broad, but it is not as broad as Nifty or as gold. Okay, it is broader than gold, I'm sorry, but it is not as broad as the Nifty. The worst is minus 33, which was global financial crisis time, 5th March 08 to 5th March 09. The best was 23rd March 22. Obviously, 23rd March 20 is the COVID time. So if you invested at that time, then exactly a year later, you got a return of 69% in rupee terms, average of 13.69%. Same way, we have done it for 2 years as well. And as you can see, when we do this, it exhibits a way, all these volatile investments exhibit the same चीज दिखता है. जैसे जैसे आप पीरियड ऑफ होल्डिंग बढ़ाते हैं, उसका वॉलेटिलिटी, द डिफरेंस बिटवीन मिनिमम रिटर्न एंड मैक्सिमम रिटर्न कम होते जाता है, और एवरेज रिटर्न करीबन करीबन सेम रहता है, थोड़ा थोड़ा कम हो जाता है. ओके, इनफैक्ट S&P में तो होता ही नहीं, इट ऑलमोस्ट रॉक स्टडी एट बिटवीन 13 and 14%. 2 साल में 33 becomes 23, 69 becomes 48, average barely changes. And now, again, we have done it for 3, 4, 5, and up to 10 years rolling returns, and including a systematic investment over 2 years, hold for 6 years, and then disinvest over the last 2 years. This is the 10 years only, but systematic hold, systematic withdrawal. These again, if you see, it's very, very similar, right? You can see that the same mountain like thing happens. As you increase the period of holding, the minimums keep going up, the maximum keeps falling, the average more or less it varies between 13 and 14%. And you can see here that the 10-year average is 14.38% compared to Nifty of 13.70%. So it does beat over 10 years. It does beat the Nifty barely. There's not much of a difference between the two. Again, these are what are called negative correlation. This is just technical jargon कि भाई जब एक बढ़ता है तो दूसरा गिरता है. इस केस में बढ़ना, gold is negatively correlated. When one rises, the other falls. But overall, both have done very well. The S&P 500, there is what is called very weak correlation. When in the 10 years that Nifty 50 has done very well, S&P 500 has done okay. In the 10 years in which S&P 500 has done very well, Nifty 50 has done okay. And this is the data that sort of shows that this is very similar, except that these are all above 0%. You can see this is the Nifty average uh, uh, somewhere here 2000 bit, and then from 2016 onwards, 10 ended 2016. Okay. Hello.
Yes, sir.
Did we get disconnected?
Yes, yes. And also your screen is not shared, sir. So I think you can share your screen. Yes, perfect. Just like, yes, sir. Now you can start.
Right.
Yes.
Okay. And this you had seen earlier when it was still being done. This screen has been seen, right?
Yes,
So
sir.
as you
Yes.
can, okay, so as you can see that the 10-year periods during which each of these perform are different. And again, therefore, that makes it a very good mix with the domestic market. It is inversely related or weakly correlated, actually. Okay. And therefore, it is a good hedge to stabilize the investment returns. The other important thing we must remember that well as the Indian market has done, well as the fact that we understand this market is there, the total market capitalization of all Indian companies put together is only 4% of the world's market capitalization. All world's listed companies, if you take their value and put it in dollar terms, including India, then India's companies constitute 4%. The US companies constitute 50%. So it's a market that's about 13 times larger than us. Okay. And that is the reason you don't ignore a market that is that big, right? And it is inversely or weakly correlated with your domestic stock market. And therefore, most planners recommend 10 to 20% allocation to the international stock market for this particular purpose. Therefore, if you look at diversifying, you include fixed deposit, which is debt, you look at the Indian stock market, you look at the US stock markets, and you look at gold. Investing in all four works much better than betting on one asset class because at different points, the journey may be 10 years, but at different points in those 10 years, the different assets are working differently. And therefore, having a mixture, having a combination gives us stability to the entire portfolio. We have looked at one possible combination, a sample portfolio, which we have said Indian stock market 55%, US stock market 20%, gold 10%, and liquid fund, fixed deposit equal to liquid fund. Those of you who have seen the first episode know that. Otherwise, please see this is the liquid fund, 15%. That is the composition of a sample portfolio, never rebalanced. You just put it in there, let it be there for 10 years. Or if you are doing systematically, do it systematically for the first 2 years, hold it for 6 years, and then withdraw systematically over the last 2 years. If you do that, these are the numbers. They absolutely same uh, characteristics it shows. As the period of holding goes up, your uh, the size of the horizontal bar, which represents the difference between minimum and maximum, keeps falling. Okay. And if you will see this, if you see the systematic entry and systematic exit over 10 years, systematic entry over 2 years, hold for 6 years, systematic exit over the last 2 years. If you do that, the minimum return is been 11%. 11%. I'm going to repeat that number. In the past, if you had invested at any point of time between 13th August 2001 to 31st December 2015, if you had invested out of your 100 rupees, if you had invested 55% in the Nifty 50, 20% in the S&P 500, 10% in gold, and the balance 15% in a liquid fund, and let it lie for 10 years. Okay. And but if you had done it systematically over the first 2 years, let it lie for 6 years, and then withdrawn systematically over the last 24 months, the last 2 years, the min possible return that you would have got was double digits. It was in 11%, and that happened in the I mean, of course, just before the demonetization. This was, if you had started this on 16th of August 2006, did it systematically till 2008, 16th August 2008, kept it for till 16th August 2014, then systematically withdrew it over the next 2 years, then the minimum investment that you would have had was 11%. The average of that would have been 12%, maximum was 16%. But so I am just going to repeat that so that the number sinks into your minds. You had to do nothing else. You just had to systematically invest over 24 months, hold for 6 years, systematically redeem over the last 24 months in that proportion that I have mentioned: 55% Nifty 50, 20%, S&P 500, 10%, gold 15%, liquid fund. If you did that, you made double digit returns. You didn't have to do anything else at all. This is just a replication of that. Okay. The sample portfolio, the minimum return was 11. The average return was 12. So you can see the average returns of gold, average return of the US stock market. This is the average return of Nifty 50. So you can see that the minimum is the highest for a combination. You're not that much compromising on average. Okay. It's almost the same as Nifty 50. It is better than gold. It's slightly lower than S&P 500. The maximum, of course, is the lowest. But do you really care about the maximum? The probability in the past of over 10 years getting a double digit return, if you followed that construct, if you followed that कि पहले 2 साल में डालो, ओके, बाद में उसको 6 साल रखो और अगले लास्ट 2 साल में निकालो, तो मिनिमम डबल डिजिट रिटर्न्स मिले हैं. Now that is the power of diversification. Okay. I, I'm just repeating it for the sake of emphasis so that I think it very clearly, the sum of parts is far more powerful than the individual parts themselves. Is known the father of modern portfolio theory. Okay, this is he created that diversification is the only free lunch in investing. It is really, really okay. People find it difficult to believe. Okay, but really speaking, diversification is the only free lunch in investment. With that, let me stop sharing, and we are uh, open for questions if there are any. There is the question and answer. Sahil?
Yes, sir.
Are there?
Yes, in Q&A, so
Q&A.
there are few
Okay, yeah,
questions.
I can see Q&As. Okay.
Hmm, hmm, hmm.
So I'm not going to answer questions on performance because I don't know the answer. Tanipu Kinshi asks, rolling means whether we should sell each year or just hold it. Rolling means if you see the example, Tanipu, uh, we started on say 13th, 1 year rolling means we started on 13th August 2001, sold off on 13th August 2002. That was observation 1. Observation 2, 14th August 2001, 14th August 2002. Observation 2. Third observation, 16th August 2001, 16th August 2002. Observation number 3. So keep shifting by one day, one working day. You keep shifting your investment date and keep shifting your redemption date by one day. So that way you capture all possible returns. 10 to 13% CAGR 10 years. This doesn't sound like a question. So Sunil Gadage asks a very interesting question. Where can we get rolling return data to study? I think rolling return data is available on some public platforms. We of course construct our own. We use the base data and construct this, but some platforms have it. I'm often not able to tell you where it is available. Where it is available for free. I think that is what you wanted to ask. Of course, if you is return applicable only when selling? Of course. I mean, this assumes at the end of 1 year, 2 year, 3 year, 4 year, 5 year, or 10 years, you will sell. Again, same question, where is the data available? We have made the data ourselves. It's not easily available. So one thing about rolling returns, first of all, people find it difficult to get the concept itself. And secondly, the data is not easily available. Okay. And therefore, it is mostly ignored. Most of the places you will find that they give you, I mean, last 1 year's return, last 2 years return, last 10 years return. But that's just one instance. And we saw in episode 1 why that can be misleading. Because if you remember, episode 1, I showed to you that if you had invested on 20th of March 2000, 23rd of March 2010 and disinvested on 23rd of March 2020, exactly 10 years later, the return would have been a measly 5%, okay, which is much lower than what you would have got for a fixed deposit over the same period. Of course, that was because of an unlucky end date, 23rd March 2020 being that manic Monday when the market crashed, I think 12 or 13% because of the COVID. So Srinivas Jagirdar asks, while assessing Nifty 50 and S&P, have you factored currency? I did mention that we have converted S&P 500 returns into rupee returns. Okay. Professor Ilakuan says, amazing made in on beyond returns. Thank you very much. Immense thanks to the thank you. Okay. These are compliments. Thank you very, very much. Uh, Srinivas Jagirdar says 55% is inclusive of SIP. I have not understood the question. Is it better to invest 5% in gold and 5% in silver instead of 10% in gold? Mr. Vijay Shankar, again, you need to run the data for that. We have separately run 10, data for gold and silver. We have not run a mixed data. Okay, so I won't be able to answer the question authoritatively. But when you look at separately gold and silver, silver just does not come into contention at all. Okay, the data is very poor for silver as compared to gold. Okay, whether a mixture works better or not, I am unable to answer. We have not done the calculations on that. Silver, there is also an issue in terms of availability. For quite some time, silver mutual funds were not available. Now, of course, they are very much available. Uh, so we will run the data. It's a very interesting thought that you have put in there. We will try and run the data to see whether the mixture works. Rituja Puri says, what are your thoughts about the RBI ban on international fund restrictions? And therefore, yes, this is something that has put a dampener, but you can use your liberalized remittance schemes. Residents in India can remit up to 250,000 USD overseas to invest in overseas investments. There are various platforms available. Those platforms are in India as well, or you can use platforms like Interactive Broker. It's fairly simple to open your account there. It's fairly simple to make a remittance through liberalized remittance schemes, and it is relatively easy to get the S&P 500, Nasdaq 100, or any other index that you might want to buy overseas. Uh, Tanipu says, please show the some chart again, pie chart again. Pie chart was only to show the sample portfolio that was 55% Nifty 50, 20%, 10% gold, and 15% liquid fund. Sir, can we go to the slide? I just repeated that. How to invest? I just mentioned that. Anshul Chaudhary, can you please use a good internet connection next time? I promise you I will. A good internet connection is essential for our business, and definitely we will make an effort to do that. What is the best way to invest in gold and S&P 500? S&P 500, I've always already mentioned. Gold, of course, various gold funds are available. Sovereign gold bond is available. You can buy it. You have to buy from the market. You can't do a SIP in a sovereign gold bond. That is the big issue with sovereign gold bonds and ETFs for that matter. Uh, the one of the ways that which is less explored, okay, is buying into multi-asset funds. So, for example, and I'm not marketing any fund here, but that probably is the only fund that is available. That's why I am naming it. Okay. So, Motilal Oswal has a fund called Asset Allocation Fund, aggressive and conservative. So, in Motilal Oswal Asset Allocation Fund, I'm just going through the name in my head. Aggressive fund, 50% is Nifty 500, not 50. Nifty 500. 20% used to be S&P 500, but now it has fallen to about 13%. Gold has grown from 10% to about 13, 14, 15%, and the balance is sort of liquid fund. It's lovely because it rebalances on its own, and that is the real beauty of that kind of a fund. Currently, that is the only way you can get exposure to the index fund, S&P 500. Is the only indirect way in which you can get exposure to that fund. How to know such stocks? I can't answer stock specific question. Does the strategy Sunil Gadge asked, does it consider tax? No, it does not consider tax at all. Okay. We haven't done. Sanjay Kolte asks what happened in case investment in S&P 500 when only Indian market is concerned. What are the rolling dividends? returns and what percentage. I haven't done in numbers. It's not that easy. I can't do it on the side and give it to you. Deepti M, other than FDs, is there any investment option where I can invest and get regular returns after a period of 3-4 years, or for as long as I keep the principal intact? So, have you looked at bond funds? Have you looked at Bharat Bond Fund? And you can do a systematic withdrawal. It is a very powerful way which is capital protected. Uh, there are no guarantees, of course, but those are AAA rated PSU bonds. And if you invest there, whatever money you need, if you withdraw systematically, it is an excellent way to take exposure, akin to a fixed deposit, very much akin to a. It's like investing in a fixed deposit in a PSU company. If we are investing in Nasdaq mutual fund for longer period, is it good investment? So Nasdaq, we have done the data on Nasdaq. Nasdaq's returns are far better than S&P 500, but they are more volatile. It's a much more narrower base. It does not have certain kinds. I don't think Nasdaq has any financial companies in it. There are 2 or 3 sectors that are not represented in Nasdaq. So it's a riskier bet, but yes, does it on an average give better returns? Yes, it does. So higher risk sometimes means higher returns. Not always. I think that is the thing to remember. We've seen that in episode 1. In today's market, both gold and investing in US market is discouraged. So what are the options to diversify today? I mean, those are the diversifications. So if you opt out of that, then I don't know. I mean, then you are left with equity and liquid funds. What is the gold performance in last 10 years vis-a-vis equity? Oh, exact last 10 years. It is not there in the top of my head. I won't be able to tell you. Okay. After 24-25, Nifty and gold both are increasing. Is it because of geopolitics? I have no idea. Thank you. One main issue about timing of the requirement, like a salaried person may not be. So we are running out of time. I'm just going to answer the more important questions. Karthik Ram asks one main issue about timing. Salaried person may not be needing any major money now and he wants to lock it for longer time for a period beyond 10 years. Of course, this will apply. Of course. 10 years is an example. If you need it for 15 years, 20 years, I think it will apply. We haven't run the numbers, but there is no reason why it will not apply. Anil Parya asked, can you repeat the name of Motilal Oswal Fund? I don't want to sound like a marketing arm of Motilal Oswal. Perfect. I think I've finished the questions. Uh, and we've done it well within the time allotted to us. Uh, Nihal, if there is anything else, happy to answer.
Yes, sir. I think you have addressed most of the questions. And also, we have noted the point regarding the network. Yes, we do face some network issue in this webinar, but we will ensure that it didn't happen again in the third episode. So, yes, I think on that note, we are and we are good to conclude the session.
So thank you everyone for being here today. Look forward to meeting you in the third episode, where what we will cover is all this knowledge that we have gained. How will we use it to construct your own financial plan? That really is episode 3.
Yes, we also sincerely want to thank your speaker, that is Harsh Rungta sir, for sharing his valuable knowledge and making today's webinar so engaging and effective. Also, thank you to all the participants for joining us today. Your active participation and support made this session a success. Also, do make sure to join the third episode, as Harsh sir mentioned, that it will be on how to build your own financial plan, and it's scheduled for the next Wednesday, that is 20 May. So yes, do join for the third episode as well. Thank you. Thank you again, sir, for your time. Thank you so much.
Thank you. Thank you.
Thank you, sir. Thank you all for joining today. Thank you.